Hello, everybody. I hope you survived the markets today. I know that it was pulling back after we had had that monumental run yesterday. So that is to be expected most of the time when markets surge like they did yesterday. You will see a pullback. It's been a little bit deeper than I would have preferred, but it is normal to definitely to be expected. Back in the car today, you may hear a little bit of noise in the background. There are lawnmowers going all over the neighborhood. Spring has sprung. But I wanted to talk to you today about my favorite bear strategy play. And I love this play because it allows you to capitalize on a stock that may be trending down. And it's actually been working very well in our community. The other day, we had used it on the QQQ, and we were able to profit quite a bit from it. So I'm going to explain it to you, but let me explain what it is first, and then I think you'll be impressed that at the end of this video, you will understand everything that I'm about to say, whereas right now it might seem a little weird and wonky. But what you're going to learn today is how to do a front put diagonal ratio spread. Now, you may have heard of a put ratio spread, but this is a little different. I always like to add a little twist to the way that I trade to actually stack the odds in my favor. And so that's what this is all about. So let me explain the dynamics of a front put diagonal ratio spread. Basically, all it is you are purchasing one put and you are selling two puts. The front portion is the fact that we are selling two puts and buying one. Now, there's something called a back ratio spread. That's where you purchase two puts and you sell one, but we're doing the front version. The diagonal comes in because I am using different expiration dates. A traditional put ratio spread will use the same expiration date. But I have found that if you go out a little bit further, it makes your trade safer because you're going out further in time, which allows you to go down deeper for your sold put. And with volatility high like this, you're getting really good premium regardless if you're pushing the trade out further. So I really like that aspect of what I'm about to show you. Let's break down the two components so you fully understand the trade. First and foremost, you are buying a put option. Now, you would only do that if you believe a stock is going down. Put options are great in a bear trending market, but there's one little issue with put options, at least that I have found. First, you're not sure when do I take profit because it could keep going down and then you get a little bit greedy and you see that it's gaining and you're not sure if you should go ahead and cash it in or should you let it continue to fall. The other thing is you're betting against the market and you're paying to do so. And most of us that are in the market, we have the thought process that the market will go up. So it's really kind of hard to bet against the market and get excited about it, especially if you're paying for something that may or may not end up paying off. So that's the issue with purchasing a put. But the way that I do it, it removes those dynamics off of the table. So let's talk about the other portion of the trade. It's the sold put. Now, most of you are probably very familiar with what a sold put is. You actually have the money in your account, or if you're using margin, a combination of cash and margin, and you're agreeing to buy a stock if it pulls back further to the strike price that you set. For that, you're getting paid a premium. Okay, that's the income portion. So now that you know the two dynamics of that, let's put it all together and talk about how this trade works. The easiest way to explain this, and I'll get into more detail once we get into the trade, is that because the way that the trade is structured, you're getting a credit when you put the trade on. Now, getting a credit is great because it allows you to profit even if the stock goes up, and it allows you to profit even if a stock pulls down, just not down so dramatically that you can't end up salvaging the trade and making a little bit of money off of it. Let's go into the computer and I'll show you what I'm talking about. I felt like Robinhood would be a good start for the put ratio spread because Robinhood is trading almost in the middle of its Bollinger Band, which means there could be some downward pressure. But when we look at the potential pricing for the downward pressure, you want to look at a level of support that you would be comfortable buying the stock at because this involves selling two puts and using the sale of those 2 puts to finance a purchased put that you would gain on the downside. So this one looks like it's in a really good spot. I'm looking at the 3-month chart, and I want to pay attention right here to this 200-day moving average. It coincides with the bottom of the Bollinger Band, and it's sitting right at around 33. So one would expect, if this stock is a healthy stock, that it would bounce off of the 200-day moving average. So I'm using that as kind of my line in the sand as I'm going on the hunt for potential plays. And before we do that, let's just take one quick look at the analysis tab, because I want to make sure that everything's in line for the health of this company. And it looks like everything is in line. I mean, we do have Q1 earnings coming up April 30th, so that would definitely add some volatility, but we're going to go far beyond that. And it does appear that they continue to bring in revenue, and they've had a massive increase in their earnings, which is very positive. If you look at their price targets, because that's always a good place to try to anchor yourself, it looks like the average price target is $58. So we're trading well below that now. And finally, analyst recommendations. It's a mix between a strong buy and a buy. Next order of business is to select the put that we want to purchase. And so for that, I like to go at least 3 months out. That helps me avoid aggressive time decay. If I select it incorrectly, it gives it time for the trade to work out. So I'm going to start with 7/18 expiration, looking for a potential put to purchase. And when I look at the option chain, I want to at least do something in the money. That way it will continue to rise if this stock falls. And I like this $40 level right here. It's got a delta of about 0.4, which is usually good. If I'm buying a put without financing it, I typically don't want to go over 0.5 because I don't want to overpay for something that I don't anticipate holding on too long. This is a more protection against a sharp downturn in the coming weeks. So I like this one right here. It's saying 685, but you do have to pay attention to the bid ask. This will probably settle in closer to around 760 will be the amount that I end up paying for this. So keeping that in mind, I am going to want to go search for a put. If I sell 2 puts, that it will pay me more than what I'm paying for this put right here. So let's go ahead and make this purchase first. You can do these all together, but I don't like to do that because I like to be able to be nimble and get in and out of them at will. So this is the one I am buying. I'm going to send it to a ticket. Again, it's saying 685, but that won't get filled when I have my bid ask at 750, 770. So I'm going to go ahead and let's put in 760 to see if we can get a fill. Okay, good. That one filled at 760. So that is the number that I want to get over. I actually want a credit for the sold puts. Now let's go in search of the sold puts. Again, on my expiration dates, typically the same expiration date is used, but I like to add a little more certainty into the trade and get more premium for going a little bit further out. So with that being said, I am going to start at the August 15th expiration date for my sold puts. Now, remember I mentioned to you that 33 was an important line because it was the 200-day moving average. So I want to focus right here on this 33. It's at a 0.26 delta, which is reasonable for going this far out. And it's currently it'll probably pay about $5. Now, if I sell 2 of these, that will give me income close to about $1,000, and I just made a purchase for around $760, hence the credit that I will receive from doing this transaction. Now, it's important that you do realize, though, when you're selling these puts, you are holding the capital or margin that is going to fulfill the obligation if it does pull down below 33, especially as we near closer to the expiration date. Then I will be on the hook to purchase 200 shares of Robinhood at the $33 strike. So it is tying up some of my capital to do this trade, but I feel like it's a fair risk to reward dynamic. Once I get to the ticket, I populate it and I'm selling 2 of these. This is the part of the trade that is the front ratio portion. If you're selling 2 puts, that equates as a front put ratio spread. If you are going to buy 2 of the puts, that would be a back put ratio spread. When I preview this, it looks like I will be receiving $970 for the trade. I had to modify it just a bit to get a fill, and it was filled at 486. So let's look at the credit after we have executed these three trades. When you break it down, I received $9.72 for the two sold puts, but I did pay $7.60 for the purchased put. So that is a credit of $212. Now let's discuss what happens as this trade moves on. The best part about a put ratio spread is because I received the credit in advance, I am going to be fine if the price of Robinhood continues to rise. And so if it does, then this purchase put right here, it won't gain any value. But that's okay because then this trade that I sold two puts on, this will be the winning trade. So I have the credit up front. So it is okay if Robinhood continues to rise because this amount is a stronger amount than what I purchased. But let's say that Robinhood starts to retreat. Well, if Robinhood starts to retreat, then what I purchased for $7.60, this will start to gain value. And once I see that Robinhood has hit a level of support, and if it bounces, then I would more than likely go ahead and take advantage of cashing this in, meaning I initially purchased it, so I would sell it for a higher amount than I bought it for. And if that were the case, and it retreated from the $33 level and started to head back up, in due time, these two puts, which I received a credit for, those will continue to profit for me. Now, I could allow this trade to play out to fruition, or I will more than likely go ahead and take profit if I see that this 486 has whittled down to about 50% of what I received for it. That would be a 50% win on this portion of the trade, and if I went ahead and sold this at profit, then that would also be a win for me. Now, if you want to protect yourself further, you would in fact leave this purchased put intact and allow the trade to continue to go down if it breaks this level of support. So let's say that we broke 33, which is that 200-day moving average, then there's a good chance we might be headed further down. Well, if that's the case, these two puts that you sold, these will show to be a losing trade. But because you have this purchased put, this will continue to gain value to help offset some of the losses that you're seeing here. But the reason I like to do these separate is I like to be nimble and I like the ability to get in and out of the trades as needed. So let's assume that it does continue to decline and we blow past this $33 put strike. Well, the beauty of that is as we get closer, I could go ahead and roll this trade down even further. Maybe I decide to roll it down to $30, pushing the trade further out, and I receive a credit doing so. So the reason I like to do this is I have flexibility regardless of the movement of the stock that allows me to profit in a variety of situations. Now, when we talk about risk to a trade like this, there are risks. So let's assume that Robinhood continues to go down. Maybe it goes down to $15 a share. So yes, this has gained value and that is helping to insulate me. But if I'm early assigned these Robinhood shares at 33 and it dips down to 15, then I'm left holding onto those shares until they come up significantly so that I can either sell them at profit or start selling calls against them. So that's why if you do this, you have to definitely have patience if you want the shares and you want to look at critical levels of support. I hope you're finding that these videos that are showing you different ways to trade a bear market will help you have another tool in your arsenal to tackle Wall Street with us every day. Remember, if you're with me and trading with Ashley, there is no trader left behind. Now, if you want to watch another video that's going to help you in these volatile markets, I've got the perfect one for you. It's right here.